Okay, good afternoon, everyone. My name is Bill Levinson, Managing Partner with Levinson and Associates. First off, before we dive in, I just want to apologize. We had a little computer issue here on our end, so we were a few minutes behind. So that is our fault. I apologize to everyone, but again, thank you for taking the time to join us today. So we have Joseph Loughran, our Marketing Vice President, and then we have the infamous Joe Ross, who, in my opinion, is one of the best trainers in the industry. He's also going to be one of our 2 keynotes at our Live Agent Expo in South Florida. So you'll get a chance to see and hear and meet Joe live in April at the Expo. So make sure you are there as well. So long story short, what we wanted to do was we put a 3-part training series together with Joe and of course the Levinson team. And this is number 2 of the 3-part training. And then number 3 is going to be the keynote. And Joe's going to talk all about indexed UL at our expo here in South Florida. Now, if you missed part 1 of the training, or if you're coming into this training a little late, or you're listening to a recorded version, just let us know if you want the actual audio or recorded version, and we can send that out to you if you want to share it with other agents, or if you just want to brush up and watch it over the weekend. So anything you want to do, we'll help you with that. That would be our pleasure. Okay, so before we jump in here, I also want to mention, I always like to give some sales ideas, concepts. It's our goal that our agents will walk away with some great nuggets of information when we host these webinars. We want to maximize every minute of your time. So write down any questions, comments. We want to hear feedback, positive, negative. We want to hear everything, okay? Because it's our job to make these things bigger and better for our field force. So I'm reading a book right now called Building a Story Brand by Donald Miller. And I can relate to what his points are, and I can relate, of course, to our agents and life insurance selling out there in the field. And the reason why I think this book is so crucial for what we do every day is he talks about building a story and of course branding and marketing, and I love his ideas, and I think that you should listen to the audio version. You can buy it on the Audible app or website, or you can of course pick up a hard copy. And the reason why I think it's important, he talks about building these stories, and as life insurance agents, it would be awesome. Okay, I always talk about using social media in your website. Pull out your cell phone, right? I mean, you have a happy client that bought, maybe a 20-year term with living benefits and whatever the case is, and they talk about how great Bill Levinson, their life insurance agent, is, and how he came to the table with this super duper product, and now I'm referring my friends and family. Record that, okay? It takes 45 seconds or a minute. Every smartphone now, you can record a video, okay? Everybody has this capability. Download it on your website or put it on your Facebook or social media pages. Blast that out. This is exactly what he's talking about. People can relate to other people going through their same exact situations. If I'm sitting there, if I'm an agent and I'm pitching, indexed UL is so great, and so is return of premium term and living benefits term, I can talk about this till I'm blue in the face, but until they hear it from a real live person just like them, okay, that's the differentiator. So anyway, I suggest take a look at this book. That's just one tiny example. And, using all of our tools, you can post these videos and blogs and articles. We make it so easy. Okay, so this is in line with exactly what we're marketing to our agents. So take advantage of this stuff. Build your brand. We want 2018 to be your best year ever. Okay, we're going to move forward. We're giving away a free tablet at the end of today's call. We also have a special guest, okay? It's Kerry Levinson, my father and president of Levinson and Associates. He's also a huge fan of Joe Ross, As you know, if you're a fan and you've been with us for a while, Kerry doesn't speak a lot on these webinars, so he said, you know what, Joe Ross is going to be on. I need to say a few words. So without further ado, my father, Kerry Levinson.
Thanks so much, Bill. Greatly appreciate it. And I also want to extend a heartfelt thank you to all of you. I know there were several hundred on this webinar today, and just for taking the time to spend with us for an hour or so. I know for a fact that it will definitely be worth your time and your effort. So thank you in advance for that. Yeah, Bill is absolutely right. I normally leave the webinars up to Bill and Joe Loughran in our office here, and but as soon as I found out that a friend of mine is going to be addressing our agents today, I asked Bill, and he did give me permission. Bill, I'm very appreciative of that. I actually did want to come on and just say that I personally know Joe Ross for close to 30 years. We worked together back in the old Conseco days, and I want to let each and every one of you know that listening to Joe will be absolutely worth your while. He's just a fantastic speaker, fantastic motivator, and a great human being. So I will absolutely not take any time away from anyone else. We are getting started a little bit late, so I'm going to turn it back over to Bill and Joe Loughran.
Thank you, Kerry. Okay, so moving forward here, we're going to go pretty quickly and then introduce Joe Ross because we are a few minutes behind. So real quick, some of the new platforms and Levinson technology for 2018. We're going to be rolling out our brand new Index UL sales software. Okay, we're calling it the iGenius IUL software platform, rolling out in the next couple weeks here. What's so great is this is going to tie in perfectly to Joe Ross's keynotes at our Levinson Expo. So we're going to talk all about the sales software, and Joe, of course, will have his piece speaking about Index UL and great sales strategies built around that concept. We just launched a new website called the LevinsonLeadProgram.com. That's a place all Levinson agents can go, not only to join in our co-op lead programs, but to also get some great lead generating ideas, okay? So that website was strictly built for lead generation, period. Check that out when you get a chance. Brand new iGenius final expense platform rolling out. So that is a four-pronged system built around final expense, including an exclusive lead program. You'll see that rolling out. Again, iGenius final expense program. Agency Automator version 2. Okay, we have stepped up our CRM tool called Agency Automator. You're going to see brand new, if you're using our free websites, you're going to see brand new revisions. Okay, and one of the pluses, it now allows you, remember that video I was talking about a couple minutes ago? So now you can, let's say, record your client who's a great fan of yours, right, raving fan, and you want to record his great testimonial about you. You can then take that video, press a button, upload it to your website, and then other prospects will see those testimonial videos. So that's a great new tool. We have many more features that we are adding to your retail website. So you're going to see that whole package roll out in the next couple weeks as well. Of course, the 2018 Levinson Expo, you do not want to miss. We rolled out our new quoting platform called LifePipe 2.0. That gives you some great new features, side-by-side comparisons. You can now quote and compare most of our products literally in seconds in real-time fashion. Makes a nice sales presentation for your consumers. If you haven't seen that yet, check out kerrylevinson.com. Just hit term quote engine and you'll see everything in front of you. Okay, so real quick, you know, one of the biggest pushbacks that we have received from agents, and you know, we like to survey our agents, see what's good and bad. And can you guys mute your phone if you don't mind? We're getting a little feedback there. Okay, so we like to ask questions, see how we're doing, what's good, what's not, what's hot. And one of the biggest pushbacks was, you know, Bill, we love what you're doing and we love all the tools and technology, but it could be a bit overwhelming. So we wanted to come back and say, we came up with a solution, okay? We answered your prayer. We are launching the infographic. We're calling this the Levinson Master Playbook, okay? And what this is, in fact, we're launching it today. You'll see this in your inbox and on our website. So this is one attachment, and it has every single tool, technology, program, lead program, everything that we offer is separated by number. Very easy to understand. There's some screenshots in front of you. You literally just say, hey, number 10, I want my own free agent website. Where do I go for that? You click number 10, gives you all the information. You are done. It's that simple. You can use this for yourself and, of course, for your entire downline. Okay, Joe's going to talk about the new mobile app, and then we're going to move forward with our feature presentation. Joe?
Yeah, thanks, Bill. So real quick, I just want to mention, if you're looking at the screen here, is kind of a screenshot of the Levinson mobile app for any smartphone, tablet. If you haven't, I absolutely recommend downloading the app. Not only can you get push notifications on new products, new updates, sales contests, even some cash bonus programs that we're running, but you can also use the app in the field to not only run quotes, maybe run your clients through a health analyzer that's built into the app. And once you do that, you can not only see quotes, rates, you can actually go right into the e-application and do an e-app from that smartphone with a drop ticket or a full e-app with e-signature. You can then also view case status and even access our proprietary agency automator CRM platform. So everything is at your fingertips. We're very, very proud of that Levinson app and all the functionality that's available. Be sure to download it today. We will send out a link this afternoon when you receive today's thank you email for joining the webinar. So if you haven't already, I highly, highly recommend downloading that mobile app. It's going to save you a ton of time in the field.
Okay, thank you, Joe. Good stuff. All right, this is that three-part training series that we put together with Joe. Session 1 is recorded. We can send it out to you. Session 2, we're on today. Session 3 is the live keynote at our Agent Expo. Okay, we're going to dive right in here. So without further ado, I want to take a second and introduce my favorite life insurance sales trainer, Joe Ross from AIG. Joe, you there?
Yeah, I'm here. Can you hear me?
Yep, loud and clear. Perfect.
Fantastic. Well, thanks for the introduction, and again, an opportunity to get together with you and your team as we prepare for the Levinson Expo on April 26th and 27th, where we're going to really have a good time because we're going to be talking about some really new and different insights into IUL. So if you're coming to the Levinson Expo thinking you knew everything you ever needed to know about IUL, I'm going to show you a couple of things at that expo that'll light your fire because it'll position IUL as an even stronger tool than most agents know that it is. But that's not our topic for today. Today we're going to talk about life insurance strategies in a constantly changing tax environment. Kerry talked about how long he and I have known one another. In fact, my career in the life insurance industry goes back beyond that. This is actually my 40th anniversary of being a licensed life and health agent from back in 1978. And if I can say one thing about the 40 years that I've been in this life insurance business, it's that it seems like I have always been in a changing tax environment. Whether it was 1982 when annuities went from FIFO to LIFO, 1987 when the MEC rules came into place, 2002 when the split dollar rules changed, tax law changes along the way, estate tax rules change along the way. It seems like tax change is constant. And so early in 2017, we noticed a phenomenon. We noticed that because of the new presidential administration and a lot of conversation about tax law being introduced, and in particular, people hearing words like estate tax might be repealed, we noticed that lots of agents and lots of advisors were virtually sitting on their hands, waiting for the dust to settle before they would do anything meaningful with their planning. And so I was asked to see if I could build out a couple of concepts that work regardless of what happens to estate tax laws, income tax laws, and things like that, that would give agents a reason to get off their hands. Now, some of that dust has settled. We know more about what's going to happen in the estate tax laws now than we did before, and we also have a new tax law in play. Yet, the things that I'm going to talk about today still have applicability to your sales activity. So let's go through this this set of concepts. There's 6 things that I want to cover today. The first one is talking a little bit about estate tax versus capital gains tax. Now, this conversation might not be as relevant as it was a year ago when we were talking about estate tax repeal, because a lot of this conversation is about estate tax repeal, yet you'll still have the takeaway of helping understand why you don't want estate taxes to be repealed. Second thing we're going to talk about is an often overlooked state estate tax and state inheritance tax, which still exists for many people in spite of the fact that the estate tax exclusion limit at the federal level has risen to now $20 million per couple. There are still a lot of people who will not pay federal estate taxes, but will still pay significant amounts of state estate or state inheritance tax. So that's another solution that we're going to talk about today. Third, we're going to talk about sheltering your client's growth without creating taxable gains. And we're going to do this 2 ways. We're going to do it in a non-modified endowment contract format, and then we're going to talk about a MEC format. It's what I like to call the intentional MEC. That may be your biggest takeaway from today, and one of the most overlooked opportunities in the life insurance landscape right now is the intentional MEC for safety net money. We'll talk about what that means to you. Fourth, we'll talk about using life insurance in blended families when you have a second marriage, especially when you have an age disparity between the 2 spouses. Fifth, we'll talk a little bit about estate equalization in a non-business environment. This is something that comes up all the time, and we should be looking for it. You probably don't have it on your radar screen. And then finally, we'll talk about taxation of trust assets. We'll use B trusts as our marquee example, but it's not simply a story about B trusts. It's a story about any money in any trust anywhere and how life insurance can help solve tax problems. So with a lot to cover and not a lot of time to do it, let's dive right in on the estate tax versus capital gains tax. Now, again, this conversation was built a lot around estate tax repeal. So the storyline last year was, I can't believe that people want estate taxes to be repealed. This should be a tax that people want to keep because it takes from the rich. It doesn't take from the poor. There are so few couples that are worth more than $20 million that nobody's paying estate tax. So we didn't have estate tax repeal, but what we had is very, very close to estate tax repeal because so many of your clients when the government does estate tax repeal, they also tend to do away with step up in basis. That's what happened in 2010 when estate tax was repealed. So it's not like transfer tax was eliminated. Transfer tax was simply changed from estate tax to capital gains tax. But now we're sitting on this estate tax exclusion limit of $10 million per person, $20 million per couple. And that's a new limit. Last year it was more like the order of $5.5 million per person, $11 million per couple. Yet in 2017, less than 1% of the people who died actually paid estate tax. So when you think about repealing estate tax, you have to ask yourself, why? The only people who are paying estate tax are those decedents that are worth an awful lot of money, and middle America should want to keep a tax like that. The unfortunate thing is that middle America doesn't understand all of what we just talked about because all they're hearing is the media push that says this death tax is a bad thing. They don't realize that it doesn't affect them. It only affects less than 1% of the people who die. The unfortunate thing is this is the same American public who in a survey about a year and a half ago said, yes, I want you to repeal Obamacare. However, I don't want you to mess with the Affordable Care Act. Okay, so again, that's something the public just doesn't understand. The Affordable Care Act and Obamacare are the exact same thing. And they want you to repeal Obamacare, but don't mess with the Affordable Care Act because they don't know for sure what they're talking about. Same thing here. They want to repeal estate tax when they don't realize they won't owe estate tax. So a large number of consumers agree that the government should repeal it, but they don't realize when it was repealed in 2007, step up in basis went away too. And that meant that subject to some excluded capital gains, like the estate tax exclusion limit, you had capital gains tax. And so what does that mean? It means the government still gets its tax. It just gets it in a different form. The problem with capital gains tax, if estate tax gets repealed, is that calculating the tax is far more difficult, because under capital gains tax rules, you have to know the cost basis of the asset, not just the value of the asset. And that's the beauty, if I can say such a thing about tax, that's the beauty of estate tax, is that unlike capital gains tax, with estate tax, you don't have to figure out the basis of the asset. Think about things like family heirlooms, a china set that's been passed down for a couple generations. When the family that owns it now dies, they don't have any receipts. They don't know what the cost basis in that asset is. And think about, I think about my house, for example. My house is 18 years old, and I've already replaced the water heater, the furnace, the air conditioner, the roof, and the flooring, all to the total of about $50,000. And I think to myself, if Mary and I passed away tomorrow, the water heater, the air conditioner, the furnace, and so on? Probably not, which means I would be paying more capital gains tax simply because my executor can't find the receipts. And think, what percentage of the population pays estate tax anyway? So with estate tax exclusion limits where they are, even at the limit they were last year, where it was $10 million or $11 million per couple, there was really no need to repeal estate tax. And the vast majority of middle America shouldn't have cared. They should want to keep that. But this is something that a lot of people don't realize about eliminating estate tax. When the estate tax exclusion limits go up, there's something that gets lost. It's a deduction called the income in respect of a decedent deduction. I'll give you just a short nutshell of how that works. Basically, if I inherit an IRA, let's just assume I'm inheriting a $1 million IRA, and let's assume that my parents owed estate taxes because the estate tax limits were much lower than they are now. Well, every dollar that my parents pay in estate tax transfers to me, the beneficiary, as an income tax deduction. Let me give you a simple example. Let's assume my parents have a $1 million IRA and they're subject to estate tax. Okay, so the estate tax rate now is around 40%. So if they paid $400,000 in estate tax on that IRA, when I inherit that $1 million IRA, I get a $400,000 income tax deduction. So instead of paying tax on the entire million of my IRA inheritance, I only pay tax on $600,000. And that saves me nearly $200,000 in income taxes. So what happens? This income in respect of a decedent deduction gets lost because the estate tax exclusion limits go up. It means the decedent's estate doesn't pay any estate taxes. And when the decedent's estate doesn't pay any estate taxes, the beneficiaries lose that deduction. So in my case, my parents, when they paid estate tax, would have saved $400,000, or pardon me, when the estate tax exclusion limits were raised, my parents would save $400,000 in estate tax. That's good. But I would lose a $400,000 income tax deduction that would cost me nearly $200,000 in additional income tax. So what people don't realize is that when the IRS raises these estate tax exclusion limits, nearly half of the estate tax savings is paid by the beneficiaries back to the government in the form of additional income tax. This is a huge deduction that very few people know about, but it's a big hit because estate tax exclusion limits have gone up. Also, think about the world 30 years ago. 30 years ago, people didn't have IRAs. They retired with pensions. Today, IRAs are one of the most significant assets in a typical retiree's portfolio. So they have all these deductible deferred assets in their retirement account. Even if step up in basis isn't repealed because estate tax laws stay in place, none of these deductible deferred assets get a step up in basis at death. And they used to get the IRD deduction, but if you get rid of the estate tax or raise the estate tax exclusion limits, you also get rid of the IRD deduction. So what happens is the decedents save estate tax, but the beneficiaries give back half of the estate tax savings because they lose their deduction. So the government giveth and the government taketh away. The point here is that IRAs are becoming one of the most significant assets transferring from one generation to the next. And many advisors aren't thinking about the tax implications because there aren't any estate taxes on that transfer. But the income taxes are significant, and now the income taxes to the beneficiary are more significant than ever because they don't get this deduction. Now, I know that was fast, but I hope that makes sense. Also, keep in mind the fact that the current top marginal tax rate is 40%. So if they repealed estate tax, they'd go to capital gains tax that has a top rate of currently 20%. Well, the capital gains tax may be better than estate tax, and even your clients today might have that problem. That could still be significant capital gains tax. And the estate tax exclusion limits are very high. The capital gains tax limits probably wouldn't be because the tax rate is so much lower. Again, if you thought eliminating estate tax meant eliminating tax, all I'm saying is you better think again and help your clients understand that eliminating estate tax is actually a bad idea, and actually a lower estate tax exclusion limit would be fine because still less than 1% of the decedents pay estate taxes, and the vast majority, 99% of the people who died, don't pay any estate tax at all. The beauty of life insurance is that whether you're paying capital gains tax, income tax, or estate tax, life insurance is a great way to help restore those reduced or lost estate values that are disappearing from the ravages of tax, because life insurance doesn't care whether assets are depleted by income tax, cap gains tax, or estate tax. Life insurance can fill the gaps where those assets are depleted and make those estates whole again. And that's going to be a theme throughout the rest of our conversation today as we move on to topic number 2, the state, estate, and inheritance tax. So in the state, estate, and inheritance tax world, first of all, we're finding that because the estate tax exclusion limits are so high, there is no deduction being passed back and forth between the states and the federal at death. If you have state estate taxes with a federal deduction, well, it doesn't help because you didn't pay any federal estate tax to deduct it from, and vice versa. So the states have largely decoupled, and that allows the states to collect their inheritance and estate tax at the state level regardless of what the government does. So state estate and state inheritance taxes suddenly become a big deal. Also, the state exclusion limits are much lower than these $20 million federal limits. In fact, some states have limits as low as $500,000. And the tax rates for these state estate and state inheritance taxes are typically ranging between 5 and 15%. In fact, I put on the screen here a table from 2017 showing the state estate tax rates. Now, this isn't the inheritance tax. This is just the state estate tax rates for the states that use a state estate tax rate. And I'm putting a circle around a couple of these states where if you are worth between $5 and $10 million, you'd be thinking to yourself, we don't have any planning to worry about. We don't have any estate taxes that we're going to owe because we're not worth more than $20 million. But if you look at that $10 million column, you could have clients worth $10 million who could be paying double-digit state estate taxes. And as you move this box over to the right, you can see that in the $20 million column, you're talking about 10 to 15 to 16.3% as the high number of state estate taxes. These can be significant numbers on these estates. So let's put the math together. You have a client that's worth $10 million, and they're saying, we don't need to do any estate planning because we won't pay any estate tax. But if they're in a state that has a 15% or so state in estate tax, they could pay $1.5 million in state transfer tax. Now, I don't know about you, but if I'm worth $10 million, I'm thinking $1.5 million is a significant number. For most of your clients, that is a real number. And for most agents, heck, $1.5 million survivorship policy, that'd be a nice sale. So if you're not thinking about the state estate and state inheritance taxes, know your state's rules, know what those issues are, and be able to have knowledgeable conversations with your clients about the implications of these taxes that they're not thinking about because they're so focused on the federal estate tax rules. Third thing we're going to talk about, and in this is your hidden gem for the day, how we shelter growth of your clients' investment assets from taxable gains. The first solution is one that you should all be familiar with. We sometimes call it LERP. As we know, there's a lot of popularity of 401ks, and this is where the vast majority of people are socking away the vast majority of their retirement assets. And then when they retire, they turn those into IRAs. And now they're living on these deductible deferred assets that are fully taxable during their retirement, fully taxable to their beneficiaries when they die. That's a big hit. And step up in basis may or may not go away. Right now, it's still here because they didn't repeal estate tax. They just raised the estate tax exclusion limits. But that really isn't even a relevant conversation with your clients that have tax deductible, tax deferred assets like IRAs, because capital gains is not only a problem at death for your clients, and your clients would get a step up in basis if they died with an asset right now. But what about capital gains while you're living? More investors grapple with capital gains tax while they're alive than they do at death. So are there ways to supplement your clients' retirement assets in a way that's protected from both income and capital gains tax? And the answer is yes. We can do what we like to call a LERP. Using annual premiums, we can supplement your client's retirement income by using a non-modified endowment contract, minimum death benefit, minimize the life insurance cost, maximize the cash value growth potential, and then use income tax-free loans and withdrawals during retirement to produce tax-free income. And as we all know, anything that's left in that policy at the time you die is all income tax-free to your beneficiaries. So as a complement to what they're already putting aside in their retirement plan at work, many clients should be thinking about the tax advantages of putting some of their allocations for retirement into the tax shelter of life insurance. Not going to talk about it today, but if anybody has seen my $5, $10, $20 story, and we'll talk about that when I come to the Expo in April 26th and 27th, it gives you the story you tell that locks up your LERP sales so that your clients can take advantage of all of these benefits. But here's the real hidden jewel here, this single premium strategy. When you're talking to retirees, many retirees have set aside in their portfolio extra money as their safety net. It's money that you and I know they're probably never going to touch. They're just scared they might need it in the event of what? What's the number one reason why people think they may need to tap into their safety net during retirement? That's right. The answer is nursing homes. It's the number one reason. And here's something that either agents don't know or agents aren't thinking about. This is one of the coolest plays in life insurance today. Create what I like to call the intentional modified endowment contract. So you have a client that has $100,000 or $200,000 or $300,000 sitting in their safety net. Let's just use a $200,000 number as an easy math. So you have a client that has $200,000 in their safety net. They don't plan to touch it. It's just there in case they go into the nursing home. They've taken that self-insurance approach. You haven't been able to talk them into nursing home long-term care insurance. You haven't been able to talk them into life insurance with a chronic illness rider yet. So they're just setting that money aside. Well, what if we repositioned that $200,000 into a life insurance policy? What would happen? Well, first of all, you'd say, why would I want to put this money into a MEC? If I put it into a MEC, it's all taxable when I access it. Well, let me ask you something. Where's your money being invested now? Oh, in mutual funds? It's being taxed whether or not you access it. Is that a good idea? If you put it inside the life insurance policy, at least it's being sheltered from tax, and it only gets taxed if you access the money. Secondly, if you don't touch the money, there is no income tax and there's no capital gains tax for as long as you're alive. And thirdly, if you don't end up using your safety net assets, all of that death benefit, which is worth much more than the value of the money you put into it, goes to your beneficiaries income tax free. Let's just say that their $200,000 deposit got them a $400,000 death benefit. Gosh, if you have a retiree investing $200,000 in certificates of deposits at less than 1% annual interest, they can't live long enough for that $200,000 to turn into $400,000. But if they put it into a life insurance policy, they might have an instantaneous death benefit of $300,000 or $400,000 that goes income tax free to their beneficiaries. They would never see that happen in their lifetime any other way, and all income tax free. But here's the hidden jewel. The hidden jewel on that strategy is we today have something we've never had before in the life insurance industry, and it's called chronic illness and long-term care riders. So imagine this. You take your client's $200,000 safety net. Their number one reason for needing that safety net is nursing home expense. They put that $200,000 into a modified endowment contract life insurance policy and add a long-term care or chronic illness rider on it. And now they have instead of $200,000 that they can access in the event they go into the nursing home, they have $400,000 that they can access in the event they go into the nursing home. And this is the part agents aren't either knowing about or talking about. When you put a long-term care or chronic illness rider on a modified endowment contract and they go on claim, that death benefit accelerates to your client income tax-free. So it's not a taxable access to that modified endowment contract asset. It is tax-free access to the $400,000 death benefit, all because they're on claim for chronic illness. So you just doubled the value of their safety net and given it to them in a way that they can access it totally income tax-free while sheltering all of the growth for the rest of their life from income tax and capital gains tax. If you're not talking about this story with your clients, you're probably missing the boat. So be aware of your retired clients that have money in what they would consider to be their safety net and show them how to leverage the value of that safety net while still having access and liquidity to the money and giving them tremendous benefit in the event they go into the nursing home. Life insurance used this way can be a great way to add tax diversification to your client's portfolio and leverage the value of those safety net assets. Number 4 on our list for today is blended families. So you have these blended families where someone remarries, and in some cases they marry a much younger spouse. Now, I don't know about your neck of the woods, never happens though, right? Hey, I got a guy that I work with who's 61 years old, whose new spouse is 32, and they have a 7-month-old baby. Yeah, this stuff happens. So what do you do when this stuff happens? Well, you get married to someone significantly younger than you are. That new bride may be similar in age to your own children's age. And so you get married to your new bride who's much younger than you are, and you say, hey, honey, we need to put a will together. Let's create an I love you will so that if either one of us dies, everything goes to the other. Well, the older spouse is likely to die first, so you have this young new spouse that's likely to inherit everything. But this young new spouse is the same age as their kids. So these kids will never inherit anything because they will die at the same time, if not sooner, than their new stepmother. So how do you solve that problem? Will the children ever inherit anything? In that scenario, probably not. The simple solution? Let's purchase a permanent life insurance policy on the older spouse. Now the children can receive income tax-free life insurance death benefit as their inheritance when their original parent dies. Then you can have your honey I love you will, and the rest of the marital assets can still go to the younger surviving spouse. So she still keeps the house, she keeps the car, she keeps the investment portfolios. That's all fine because the kids got life insurance death benefits. And then that surviving spouse lives off all of those remaining assets, and when she dies, all of those assets then get passed ultimately to the grandchildren, and everybody wins. So be looking again for these marital relationships where it's a remarriage and and one spouse is significantly younger than the other. Tremendous opportunity for life insurance. 5th scenario, estate equalization. Most of us, when we're thinking about estate equalization, are thinking about business ownership, where one child wants to take over the family business, the other children don't, so the one child's going to inherit the business, which is the preponderance of the family's wealth, and the other kids are going to inherit next to nothing. We've all been down that road. But what's a more typical path that we see? This happens a lot, especially in rural towns. I see this. I have a good friend of mine who just did this exact thing. So here's a scenario. Here's me and Mary. So Mary and I, we have this house we bought for $100,000 about 50 years ago. We're now getting close to passing on. We're in our retirement years, and that house is now worth $600,000. So we've got our 3 kids John, Jackie, and Brian, and we got this house that's worth $600,000 with $100,000 of cost basis in it. Hopefully estate tax laws will stay in place, so we'll get a step up in basis on that house when we die. And in addition to what Mary is getting from her, let's just say she was a school teacher, she's got a pension coming in, I've also squirreled away another, let's say $400,000 in my 401k. That's now in my IRA. And Mary and I are getting along just fine. We've got her pension, we've got the income from our $400,000, we've got our $600,000 house. If we really get into a deep hole, we could do a reverse mortgage or something like that, but we're not expecting that to happen. And so here's our three kids, John, Jackie, and Brian. Now, as is often the case in small towns, kids tend to flee to the big cities. So let's just say that son John decided he's going to stay in town. He works locally. He's running a business here in town. Jackie and Brian, they've moved elsewhere and live somewhere else. John has always thought to himself, wouldn't it be neat if I could raise my kids in the same bedroom I grew up in? So John wants that house. So Mary and I decide we're going to give our son John this $600,000 house. Well, what's the problem? That means Brian and Jackie only get to split the other $400,000. They're only going to get $200,000 each. Jackie and Brian are going to feel like they got shorted because John got $600,000. Jackie and Brian only got $400,000 to split $200,000 each. Well, if we let them split an $800,000 life insurance policy too, that means they'll each get $400,000 from the life insurance. They'll each get $200,000 of the IRA. John and Jackie and Brian all get the same $600,000 value in their inheritance. So what you look at here is look for your clients that have significant assets that are difficult to divide, that are likely to go to one child, and you can then rebalance the values of the inheritance with life insurance to create estate equalization. The last thing I'm going to put on my list today is taxation of assets and trusts. There simply is not enough life insurance inside of trusts. And I'm not just talking about what we think of as the traditional ILIT, where you're trying to take death benefits out of the estate. For most of your clients, taking death benefits out of the estate is no longer an issue. If they're worth $6 million and they want to buy $1 million life insurance policy, they don't need an ILIT, because even if they put that $1 million death benefit in their estate, it's only $7 million, and they don't pay estate tax till they get to $20 million. So they don't have an estate tax problem. This is actually kind of a benefit to us because we can buy a bunch of life insurance for our clients now, and we don't need to get the attorney involved to draft the ILIT. We don't need to make premium gifts. We don't need crummy notices. This is one of the benefits of the current high-level estate tax exclusion limit. But there are a lot of trusts that have money inside of them that are all being hit with taxation at trust taxation levels. And we all know that trust taxation reaches the maximum marginal rate at around $15,000 of income, whereas individual tax rates reach the maximum marginal tax rate somewhere in the $450,000 range. Huge difference. So assets and trusts get taxed worse. So let me give you just a quick example. This is my B-Trust example. Let's just say you have a client whose parents died 15 years ago when the estate tax exclusion limit was $1 million each. So mom and dad were worth $5 million. They could exclude $1 million each, so they could exclude a total of $2 million. So this is what happens. Mom and dad are worth $5 million. They have an estate tax problem. Remember, this is 15 years ago. So when dad dies, dad's going to put $1 million into the B-Trust to shelter it, take advantage of his estate tax exclusion limit, which at that time was $1 million. The other $4 million is going to go directly to mom. When mom dies, mom wants to take advantage of her estate tax exclusion limit as well. So mom's going to send $1 million directly to the kids, which takes advantage of her $1 million estate tax exclusion limit. So far we have $2 million going to the kids completely estate tax free. Now what happens? Well, mom has another $3 million that's subject to estate tax, and in the 40% estate tax rate, that's going to cost about $1.2 million in estate taxes, leaving about $1.8 million. So when you add that $1.8 million back to the $2 million, the kids will inherit total $3.8 million. Now, in our world, we would say, hey, you're losing, $1.2 million of your estate. Let's buy a $1.2 million life insurance policy, put it in an ILIT. But let's not go there because there is no estate tax problem today. What I'm looking at is this client died 15 years ago. Your client is their son or daughter who's receiving, your client is the surviving spouse who's sitting on this B-Trust. So let's assume dad died, created the $1 million B-Trust, and mom lived. So mom's sitting on this $1 million B-Trust. What's happening to the assets in that $1 million B-Trust? They're being invested and subject to trust tax rates every single year. So let's take an example. And this is an old, I didn't want to just take the limelight example of the young surviving spouse. So this spouse, in this example, her husband died 15 years ago when she was 65. She's now 80. She's got $1 million sitting in this B trust. If she lives another 15 years, and what I have, you can see at the caveat underneath, it assumes a 3% net growth rate. So I'm assuming that she's getting a 4% growth, paying 25% tax, so she nets 3% growth inside the trust. If she lives another 15 years to age 95, that trust will be worth $1.5 million. If this 80-year-old gal was in Standard Health and dropped that $1 million into a guaranteed death benefit life insurance policy right now, she would get an immediate guaranteed death benefit of $1.5 million. She wouldn't have to wait 15 years for her legacy to be worth $1.5 million. She would be absolutely guaranteed that today, if she dies, her legacy will be $1.5 million, totally income tax free. And even though she only put in $1 million and she's getting back $1.5 million, seems like a step up in basis, but because it's life insurance death benefit, it's all income tax free to the beneficiaries. So again, you have clients, look for surviving spouses, any widows or widowers, whether they've remarried or not. Find widows and widowers whose spouse died 10 or 15 years ago when the estate tax exclusion limits were lower. When you find them, find out if they have a B trust. If they have a B trust, you can leverage the value of that B trust by putting life insurance inside of the B trust. But not just B trusts. Any trust you find that's a taxable trust, consider incorporating life insurance into the trust to get rid of the income taxes, get rid of the capital gains taxes, and secure a leveraged increased value in the value of that trust. So this is a rocket ride through 6 different ideas that will help get you and your clients from sitting on your hands not doing things that you could be doing. These are ideas that many of you have known about. Some of you have succeeded with in the past. You just don't do them anymore. Hopefully this inspires you to start asking questions that you haven't asked of your clients before and creating opportunities that you might not have seen for a long time. As I said in my opening, I've watched a lot of tax law changes throughout the years, and many times those tax law changes said, that spells the end of our industry. We'll never be able to sell this stuff again. And over again, we find opportunities. So don't let the tax law changes scare you away. Remember, the tax law change can bring opportunity. And as long as you're looking at things like this, you'll find those opportunities and you will create sales that will put your 2018 on the path to great success. So with that, I'm going to turn it back over to the team from Levinson and Associates. Bill, Joe, if you want to open the lines for questions, or if you're taking questions online, if anyone has any questions, we can pick those up. Otherwise, we can put a ribbon and a bow on this, and I will look forward to seeing everyone on the 26th and 27th of April at the Expo.
Awesome. Great job, Joe. We appreciate that. We actually have a closed line because the number of attendees. So any questions, shoot us an email or call us. We can always get Joe Ross involved if needed. We're also going to send out an email to everybody that was on the call, and we'll include some of this information that Joe touched on today. You know, keep in mind, all we're doing today and what Joe is trying to touch on, it's just different ideas, ways to uncover a need for life insurance. And, you know, typically if you can get your foot in the door, share your story, and uncover a need with one of these products that Joe was referring to, with an IUL or a UL, these are big ticket policies, okay, where, you know, commissions could range from $10,000 to $200-300 grand of annual premium a year and commissions. So this is great stuff here. Of course, you know, have the smaller stuff keeping the lights on, but if you stumble across one of these cases, that really will make a difference in your year. So awesome stuff there. We're going to run for about 5 more minutes. We'll end at 3 p.m. Eastern sharp. We're going to give away a tablet in just a couple more minutes. Again, special thank you to Joe Ross. The guy is amazing, and I hope everyone now can agree with me. When you see him in person at our Expo Live, even bigger and better. When I say bigger, he's like 6'6". So I mean that. The proof is in the pudding. Joe's going to take it from here, Lochran, and we'll move forward. Joe, you there?
Yeah, thanks, Bill. I want to mention real quick some upcoming training events. Of course, you can go right to kerrylevinson.com and register for any one of our upcoming webinars right from the training calendar. Bill mentioned the Agency Automator platform as one of our kickoff tools. We've been really introducing some new changes for 2018. We have training every Tuesday and Thursday at 2 p.m. Eastern, and then just beneath that, Agency Automator Plus, which is the same platform but designed for GAs to kind of recruit and build their hierarchy, training every Monday and Wednesday at 2 p.m. Eastern. For next week, on the 22nd at 2 p.m. Eastern, we have a special webinar with a couple guest speakers, a lead program creator, and an agent of ours that's been using that lead program for several years, really covering the co-op mortgage lead program. We're going to talk about tips and hints and ways to kind of develop more business by using all those different co-op lead programs that we offer to Levinson agents.
Okay, good stuff, Joe. Okay, the expo we keep referring to, I hope you have registered by now. If not, no problem. Go to kerrylevinson.com. We'll also include a link in today's email that's going out to all participants. We have 2 keynote speakers here. Joe Ross will be one. The second is Neil, that's responsible for creating our IUL software platform. So together with those 2 keynotes, combined with our top VPs, underwriters from around the country, our top agents and agencies from around the country. So great day for sales strategies and networking. Okay, you talk about sales nuggets, that will be the ultimate day. April 27th, 2018. Don't miss that day. Okay, tablet giveaway, and then we're going to end with our Positive Tuesday quote, where in fact we're right before 3 o'clock here, so just on time. Okay, the 150th registrant. So we're going to mail your tablet. We have a 16 gig tablet, built-in camera. This is the new Amazon Kindle Fire. Goes to L. Fallstitch. L. Fallstitch, congratulations. And we're going to end with this. And you know, I like to always talk about, you know, keeping one eyeball on today's business and your day-to-day operations, and your other eyeball should be looking at tomorrow consistently, constantly, persistently. Now, this is talk about proof in the pudding. That is a cover that I'm holding up. That was 2014, 4 years ago. We made the cover, and the reason why everybody was looking at us in the industry saying, wow, you know, they're talking about a online client-driven term product called Lightning Term. First time this has ever been done. People thought I was crazy, okay? Other carriers, reinsurance companies looked at us and say, who's the carrier behind this? Why would someone take a term product and throw it online and just have clients go in and quote themselves and apply themselves and have a policy sent within a couple days? That sounds crazy. Okay, that was 4 years ago. Today we have over 10 products that are on this same client-driven platform. We call it Sell While You Sleep, okay? So the point behind this, you talk about having one eye on today, one eye on tomorrow. We do exactly that, and we're not going to stop here. So we're going to end with our Positive Tuesday quote. Remember, you are only confined by the walls you build yourself. Time to knock them down and rebuild. Let's all have a great 2018, great rest of the week, great weekend, and good selling. Take care.